Beginner's Guide to Navigating Cryptocurrency Exchanges. Cryptocurrency exchanges are the heart of the digital currency ecosystem, offering platforms for trading assets like Bitcoin, Ethereum, and countless altcoins. However, the world of crypto can seem complex and intimidating to beginners. With terms like blockchain, wallets, and market orders, diving into this space can feel overwhelming. Understanding how to navigate cryptocurrency exchanges is essential for anyone looking to get involved in crypto trading or investing. In this beginner's guide, we'll walk through the crucial aspects of cryptocurrency exchanges and help you become more confident in your digital trading journey. What is a cryptocurrency exchange? At its core, a cryptocurrency exchange is a platform that facilitates the buying, selling, and trading of digital currencies. These exchanges serve as a marketplace where users can trade cryptocurrencies, similar to how stock exchanges work for traditional assets. There are different types of exchanges, centralized and decentralized, and understanding the differences between them is essential for making informed decisions about where to trade. Centralized versus decentralized exchanges. Centralized exchanges, CEX, are the most common type of cryptocurrency exchange. Examples include Binance, Coinbase, Kraken, and Gemini. These platforms are run by central entities or companies that manage all the trades and handle user funds. When you use a CEX, the exchange stores your assets in a wallet controlled by the platform. In return, users can enjoy a smooth user experience with advanced trading tools, customer support, and high liquidity, which helps ensure that users can easily buy or sell their assets at market prices. On the other hand, decentralized exchanges, DEX, like Uniswap or PancakeSwap work differently. Rather than relying on a centralized authority, DEXs operate on blockchain networks that allow peer-to-peer trading. This means users retain control over their assets, reducing the risk of hacks or exchange closures. While decentralized exchanges offer more security and privacy, they can be more complex for beginners, as they typically lack the user-friendly features found on centralized platforms. Transactions on a DEX are also subject to network fees, which can fluctuate based on demand and blockchain congestion. When starting out, most beginners prefer centralized exchanges due to their ease of use and robust support systems. However, as you become more experienced, you may want to explore decentralized exchanges for their greater security and privacy benefits. Choosing the right cryptocurrency exchange. With so many exchanges available, choosing the right one can be daunting. Here are a few key factors to consider before making your decision. Reputation and security. Always opt for exchanges that have a solid reputation and a proven track record of securing user funds. Research the platform's security protocols, such as two-factor authentication, 2FA, cold storage for assets, and insurance policies in case of a breach. You don't want to risk losing your assets due to a hack or an unreliable exchange. Supported cryptocurrencies. Not all exchanges offer the same selection of cryptocurrencies. If you're interested in trading a specific coin or token, make sure the exchange supports it. Larger platforms like Binance and Coinbase support a wide variety of cryptocurrencies, but smaller altcoins might only be available on more niche exchanges. Fees. Every exchange charges fees for trading, withdrawals, or deposits. These fees can vary significantly between platforms, so it's essential to understand what you'll be paying. Centralized exchanges often charge trading fees that range from 0.1% to 0.5%, while decentralized exchanges might have lower trading fees but require you to pay for gas fees on the blockchain. Liquidity. Liquidity refers to the ease with which you can buy or sell a particular cryptocurrency on the exchange without significantly affecting its price. High liquidity is essential, as it allows for quick transactions at fair prices. Popular exchanges like Binance and Coinbase typically offer high liquidity across a wide range of assets. User interface. A beginner-friendly interface can make the difference between a positive or negative experience. Many exchanges offer simple, intuitive platforms for beginners, as well as advanced trading features for experienced users. Before committing to an exchange, spend some time exploring its interface to ensure it's easy to navigate. Payment methods. Not all exchanges support the same deposit and withdrawal methods. If you want to buy cryptocurrency with fiat money, such as USD, EUR, etc., Make sure the exchange supports your preferred payment method, whether it's credit cards, bank transfers, or PayPal. Setting up an account on a cryptocurrency exchange. Once you've chosen an exchange, the next step is to create an account. The process is generally straightforward but can vary slightly depending on the platform. Most exchanges require users to provide their email address, create a secure password, and undergo identity verification, KYC, to comply with anti-money laundering, AML, regulations. KYC verification typically involves submitting personal information, such as your full name, address, date of birth, and government-issued ID. This process helps prevent fraud and ensures that the exchange is compliant with regulatory standards. Once verified, you'll have full access to your account, allowing you to deposit funds and begin trading. Funding your account. After setting up your account, the next step is to deposit funds. Most exchanges allow you to deposit either fiat currency or cryptocurrency. If you're new to crypto, you'll likely deposit fiat currency, which can be done using a variety of payment methods, including credit, debit cards, bank transfers, or even PayPal, depending on the platform. If you're transferring cryptocurrency to an exchange, make sure to select the correct network for the deposit. For instance, if you're sending Ethereum, ETH, you'll need to choose the Ethereum network, as other networks like Binance Smart Chain or Polygon may not support the same tokens. Always double-check the deposit instructions to avoid losing your assets. Understanding different order types when trading cryptocurrencies. Understanding the different types of orders is crucial to making informed decisions. The most common types of orders include market order. A market order is a request to buy or sell a cryptocurrency at the best available price. This type of order is executed instantly, making it ideal for beginners who want to quickly enter or exit a trade. Limit order. A limit order is an order to buy or sell a cryptocurrency at a specific price. Unlike a market order, a limit order only gets executed when the price reaches the level you've set. This type of order gives you more control over the price at which you enter or exit a trade but may not be filled if the market doesn't reach your desired price. Stop-loss order. A stop-loss order is a type of order designed to limit your losses. When you set a stop-loss order, the exchange will automatically sell your asset if its price falls below a specific threshold. This can help protect you from significant losses during volatile market conditions. Take-profit order. A take-profit order is similar to a stop-loss order but works in reverse. It automatically sells your asset when the price reaches a certain level of profit. This type of order is used to lock in gains without having to constantly monitor the market. Trading strategies and risk management. Once you're comfortable with the basics of using an exchange, it's important to learn how to develop a trading strategy and manage risk. Cryptocurrency markets are highly volatile, and while this volatility presents opportunities, it also increases the risk of significant losses. Having a solid risk management plan in place is essential for protecting your investments. Some common strategies include hodling. Hodling, a term derived from a misspelled word, hold, is a long-term strategy where you buy a cryptocurrency and hold onto it, regardless of short-term price fluctuations. This strategy is popular among those who believe in the long-term growth potential of a specific cryptocurrency. Day trading. Day trading involves buying and selling assets within a short time frame, usually within a single day, to profit from small price movements. This strategy requires a solid understanding of market trends, technical analysis, and the ability to make quick decisions. Swing trading. Swing traders aim to capture price swings over a longer period, typically a few days or weeks. This strategy is based on identifying trends and using technical analysis to time market entries and exits. Dollar cost averaging, DCA. DCA is a strategy where you invest a fixed amount of money into a cryptocurrency at regular intervals, regardless of its price. This method helps reduce the impact of short-term volatility and lowers the average cost per unit over time. No matter what strategy you choose, risk management is key. Never invest more than you can afford to lose, and consider setting stop-loss orders to protect your portfolio from significant downturns. Withdrawing funds from the exchange. When you're ready to withdraw your funds, whether it's cryptocurrency or fiat, the process is similar to making a deposit. If you're withdrawing crypto, you'll need to provide your wallet address, ensuring that it matches the network of the cryptocurrency you're withdrawing. For fiat withdrawals, exchanges typically require you to link your bank account, and processing times can vary depending on the exchange and payment method used. Bank transfers may take several days, while withdrawals to PayPal or other payment platforms can be faster. Top strategies for trading cryptocurrencies successfully. Cryptocurrency trading offers the potential for significant profits, but it also carries a high level of risk. With the volatile nature of digital assets, it can be difficult to know how to approach this market effectively. Successful crypto trading requires more than just luck. It demands the right strategies, discipline, and knowledge. In this video, we will explore the top strategies for trading cryptocurrencies successfully, providing valuable insights that can help you navigate the market with more confidence and achieve better outcomes in your trades. Understanding cryptocurrency markets. Before diving into the strategies, it's important to understand the cryptocurrency market itself. Cryptocurrencies, such as Bitcoin, Ethereum, and numerous altcoins, are traded on cryptocurrency exchanges, and the market is notoriously volatile. Unlike traditional stock markets, crypto markets operate 24/7, which means there are always trading opportunities but also continuous price fluctuations. Traders need to be prepared for rapid price movements and have strategies in place to manage these shifts. The primary factors influencing the prices of cryptocurrencies include market sentiment, regulatory news, technological developments, and macroeconomic events. Unlike stocks, cryptocurrencies are less influenced by company earnings or financial reports and are more susceptible to speculative trading and hype. Understanding these factors and being able to react to them appropriately is key to succeeding in crypto trading. 1. Hodling. Long-term investment strategy. One of the most popular strategies among cryptocurrency investors is hodling, a term derived from a misspelled word, hold. This strategy involves buying a cryptocurrency and holding onto it for the long term, often for years, regardless of short-term market fluctuations. The idea behind hodling is based on the belief that the long-term value of the cryptocurrency will increase significantly over time. Hodling works best with established cryptocurrencies, such as Bitcoin and Ethereum, which have a solid track record and large communities backing them. The strategy assumes that even though the market will experience periods of volatility, the overall trajectory of these digital assets will be upward. By holding onto your assets, you avoid making knee-jerk reactions to short-term price swings, allowing you to ride out market downturns. 2. Day trading. Taking advantage of short-term movements. Day trading is a strategy that involves buying and selling cryptocurrencies within a single day, aiming to profit from short-term price fluctuations. Day traders rely on market analysis, charts, and patterns to predict short-term movements and execute multiple trades throughout the day. This type of trading requires a keen understanding of technical analysis, including candlestick patterns, support and resistance levels, and indicators like moving averages, MA, relative strength index, RSI, and Bollinger Bands. Day trading in the cryptocurrency market is highly demanding, as traders must stay glued to their screens, monitoring price movements and making split-second decisions. However, it also provides the potential for significant profits in a short period if done correctly. This strategy is best suited for experienced traders who are comfortable with the fast-paced nature of the market and can make informed decisions quickly. Beginners should approach day trading with caution, as it requires skill, experience, and the ability to handle stress. 3. Swing trading. Profiting from medium-term trends. Swing trading is a strategy that attempts to profit from medium-term price movements over a period of days or weeks. Unlike day trading, swing traders do not need to monitor the market constantly. Instead, they focus on identifying price swings or trends, entering trades when a significant price movement is expected and exiting once the trend starts to reverse. Swing traders typically use a combination of technical analysis and market sentiment to identify trends. Indicators like moving averages, MACD, moving average convergence divergence, and Fibonacci retracement levels can help identify the right time to enter and exit positions. This strategy is ideal for those who can't dedicate full-time hours to monitoring the markets but still want to capitalize on medium-term trends. 4. Scalping. Making small profits from frequent trades. Scalping is a short-term trading strategy that involves making a large number of small trades to profit from tiny price movements. The idea behind scalping is that while individual price changes might be small, frequent trades can accumulate to significant profits. Scalpers take advantage of liquidity and small inefficiencies in the market to make profits quickly. They often rely on trading bots or high-frequency trading techniques to execute many orders in a short amount of time. Scalping requires a lot of focus, and traders need to be able to react quickly to price changes. It also requires low trading fees because the profitability of each trade is minimal. This strategy can be very demanding and is generally not recommended for beginners, as it requires a strong understanding of market mechanics, trading platforms, and speed. 5. Dollar cost averaging, DCA. A risk mitigation strategy. Dollar cost averaging, DCA, is a long-term strategy designed to reduce the impact of volatility by spreading out the investment over time. With DCA, traders or investors buy a fixed amount of cryptocurrency at regular intervals, regardless of the asset's price. For example, instead of investing $1,000 in Bitcoin at once, you might invest $100 every month over 10 months. DCA helps mitigate the risk of entering the market at the wrong time, particularly when the market is highly volatile. By purchasing at regular intervals, you avoid trying to time the market, which can be challenging even for experienced traders. While DCA won't make you a quick profit, it's an effective strategy for long-term investors who want to accumulate cryptocurrencies over time. 6. Trend following. Riding the market waves. Trend following is a strategy that involves identifying and trading in the direction of the prevailing market trend. The idea is to buy when the market is in an uptrend and sell when it's in a downtrend. Traders who use this strategy rely on technical analysis tools to identify trends early and ride them for as long as possible. Indicators such as moving averages, MA, and the average directional index, ADX, are often used to spot trends. Trend following requires patience and discipline, as traders must be able to stay in a trade as long as the trend is intact and avoid getting caught in market reversals. One of the challenges of this strategy is that trends can change suddenly, so traders need to be vigilant and use risk management tools like stop-loss orders to protect against losses. This strategy works well in markets that are experiencing clear uptrends or downtrends, but it can be challenging in sideways or choppy markets. Trend followers often use trailing stop-loss orders to lock in profits as a trend moves in their favor. 7. Arbitrage. Taking advantage of price differences across exchanges. Arbitrage is a strategy that takes advantage of price differences between different exchanges. Because cryptocurrency markets operate on multiple platforms, the price of the same cryptocurrency can vary slightly between exchanges. Traders using arbitrage buy the asset at a lower price on one exchange and sell it at a higher price on another, pocketing the difference as profit. Arbitrage opportunities are often short-lived and require quick execution, as price discrepancies between exchanges can close within minutes. This strategy is best suited for experienced traders who can identify opportunities quickly and execute trades efficiently. Additionally, transaction fees and withdrawal limits may impact the profitability of arbitrage trades. Arbitrage can be profitable but requires significant capital and the ability to manage multiple exchange accounts simultaneously. 8. Risk management. Protecting your capital. One of the most important aspects of successful cryptocurrency trading is effective risk management. Cryptocurrency markets are highly volatile, and it's essential to protect your capital from large losses. A good risk management strategy involves using stop-loss orders, diversifying your portfolio, and never risking more than a small percentage of your capital on a single trade. Stop-loss orders are designed to limit your losses by automatically selling an asset when its price falls below a certain threshold. Setting a stop-loss can help you protect your investments from sharp market downturns and prevent emotional decision-making. Diversification is also crucial in managing risk. By spreading your investments across multiple cryptocurrencies, you reduce the likelihood of a significant loss if one asset performs poorly. Additionally, avoiding the temptation to overtrade or use excessive leverage can help you maintain a more balanced and disciplined approach. Evaluating altcoins. Spotting the next big opportunity with thousands of alternative coins, commonly known as altcoins, emerging on various blockchain platforms. The world of cryptocurrency has expanded significantly beyond Bitcoin and Ethereum. These altcoins offer different use cases, underlying technologies, and market opportunities, making them highly attractive to investors and traders looking to diversify their portfolios. However, with the large number of altcoins available, identifying the next big opportunity can be challenging, especially given the volatility and risk inherent in the crypto market. And strategies for capitalizing on the next big opportunity in the cryptocurrency space. In this video, we'll explore key factors to consider when evaluating altcoins, how to spot promising projects, what are altcoins. Altcoins refer to any cryptocurrency other than Bitcoin. The term is a combination of alternative and coin, highlighting the fact that these digital assets offer alternatives to Bitcoin's dominance in the cryptocurrency market. The term encompasses a wide variety of tokens, ranging from well-established coins like Litecoin and Ripple, XRP, to new and emerging projects looking to disrupt various industries, such as decentralized finance, DeFi, non-fungible tokens, NFTs, and more. While Bitcoin is seen as a store of value and the primary digital asset for peer-to-peer transactions, altcoins often aim to address perceived shortcomings in Bitcoin's design, introduce novel features, or target specific niches within the broader crypto ecosystem. For example, Ethereum introduced smart contracts, which enabled the creation of decentralized applications, DApps, and the broader DeFi movement, while Solana and Cardano focus on scalability and faster transaction speeds. Due to the sheer number of altcoins, the cryptocurrency space can feel overwhelming to newcomers, and not all altcoins will succeed in the long run. For investors and traders looking to identify promising altcoins, evaluating them properly is crucial in spotting the next big opportunity. 1. Research the project's white paper. Every cryptocurrency project typically has a white paper, an official document that outlines the technical aspects, goals, use cases, and future roadmap of the altcoin. Reading the white paper is an essential first step when evaluating any altcoin. It provides insight into the vision behind the project and how it intends to solve existing problems in the cryptocurrency space or beyond. A solid white paper should clearly articulate the following elements. Problem and solution. What problem is the altcoin trying to solve, and how does it propose to solve it? A successful altcoin should address a specific pain point in the market and offer a unique value proposition. Technology. What technology does the project rely on? Are there technical innovations that could provide an edge in scalability, security, or decentralization? Projects built on novel or scalable blockchain technology are more likely to succeed in the long run. Tokenomics. Tokenomics refers to the economic structure of the altcoin. This includes details about the total supply, token distribution, staking mechanisms, and incentives for network participants. A well-balanced tokenomics structure can help ensure the coin's long-term sustainability and encourage adoption. 2. Evaluate the team behind the project. The strength of the team behind an altcoin is a critical factor in its success. A strong team with experience in blockchain development, finance, or relevant industries will significantly increase the chances of the project succeeding. Look for the following attributes when evaluating the team. Experience. Does the team have experience in blockchain development or relevant technical fields? Are the members well known in the crypto community or have they previously worked on successful projects? Public profiles. Check the team's public profiles, such as LinkedIn, Twitter, or personal websites. Are they active in the crypto community? Are they transparent about their roles and involvement in the project? Advisors and partnerships. Many successful cryptocurrency projects have high-profile advisors or strategic partnerships with major companies. Check if the altcoin project has reputable advisors who bring industry expertise or credibility to the table. 3. Analyze the community support. A strong, active community is one of the most reliable indicators of an altcoin's long-term potential. Community support can drive adoption, increase demand, and create network effects that are essential for the success of a cryptocurrency. Here are several ways to evaluate the community behind an altcoin. Social media activity. Check the altcoin's presence on platforms like Twitter, Reddit, and Telegram. An active community will often engage in discussions, share updates, and ask questions about the project. Strong community engagement shows that there is genuine interest in the project, which could lead to higher adoption. Developer activity. Explore platforms like GitHub to monitor the development activity of the project. Are developers actively contributing to the codebase? Regular updates and bug fixes indicate that the project is being actively worked on and improved over time. Community events. Some altcoin projects host online or offline events, such as webinars, AMAs, Ask Me Anything, and conferences, to engage with their community. These events are valuable for building a loyal following and showing that the team is transparent and willing to interact with supporters. The more passionate and engaged the community is, the higher the likelihood that the altcoin will gain adoption and remain relevant in the long term. Community-driven projects often enjoy organic growth, leading to more widespread use and increased value. 4. Consider the use case and market demand when evaluating an altcoin. It's important to assess its use case and whether there is real market demand for the solution it offers. Many altcoins are created with the goal of improving upon Bitcoin's shortcomings or addressing specific needs in various industries. However, just because an altcoin has an innovative idea doesn't mean there is a market for it. Ask the following questions when considering the altcoin's use case. Real-world application. Does the altcoin offer a solution that is applicable to real-world problems? Does it have a clear use case that provides value to users and businesses? For example, Ethereum's smart contract functionality has real-world applications in DeFi, while Chainlink enables smart contracts to interact with off-chain data. Competitors. Are there existing projects that address the same problem? If so, how does the altcoin differentiate itself? For instance, if an altcoin aims to solve scalability issues, is it offering a unique solution compared to established coins like Solana or Polkadot? Adoption. Is the altcoin being adopted by users, developers, or businesses? An altcoin may have a great idea, but if it doesn't gain traction, it will likely struggle to succeed. Assess whether the project has gained attention from major players in the industry or has attracted partnerships with businesses that are willing to integrate the technology. A successful altcoin must solve a meaningful problem and be able to attract a substantial user base. Projects that are tailored to niche markets with limited potential may not provide the same opportunity for growth as those targeting large, underserved markets. 5. Monitor the liquidity and market capitalization. When evaluating altcoins, it's important to consider the market capitalization and liquidity of the asset. Market capitalization refers to the total value of the cryptocurrency, calculated by multiplying the circulating supply by the current price. High market capitalization typically indicates a well-established project with a significant user base and strong market presence. However, new or smaller projects may have lower market capitalization, which could offer higher growth potential but also increased risk. Liquidity is another important factor to consider. Liquidity refers to how easily an altcoin can be bought or sold without causing significant price fluctuations. Altcoins with low liquidity may experience price manipulation or large price swings, which can make them riskier to trade. Look for altcoins with sufficient liquidity on reputable exchanges to ensure that you can enter and exit positions without major difficulties. 6. Evaluate the tokenomics. Tokenomics refers to the economic structure of the cryptocurrency, including aspects like the token supply, distribution mechanisms, inflation rates, and incentives for participants. Understanding tokenomics is crucial because it directly impacts the value and sustainability of the altcoin. Key aspects of tokenomics to evaluate include: total supply. What is the maximum supply of tokens? Is the supply capped, or will new tokens be created over time? Coins with unlimited supply can experience inflation, potentially diluting the value of the asset. Token distribution. How are tokens distributed? A fair distribution model ensures that the project is accessible to a wide range of investors. Be cautious of projects where a large portion of tokens is held by the team or early investors, as this could lead to centralization and potential market manipulation. Utility. Does the altcoin have a clear utility within its ecosystem? Tokens that have multiple use cases within the project, such as staking, governance, or transaction fees, are more likely to retain value over time. Staking and mining. Exploring crypto passive income options. As the world of cryptocurrency continues to expand, more and more individuals are seeking ways to earn passive income from their digital assets. Two of the most popular methods for generating passive income in the crypto space are staking and mining. Both staking and mining allow cryptocurrency holders to earn rewards by participating in the network's operations, but they do so in different ways, each with its own unique set of advantages, risks, and requirements. Understanding how each method works and which one might be best suited to your investment strategy is crucial for maximizing returns while minimizing risks. In this video, we'll dive deep into both staking and mining, exploring their fundamentals, how they operate, and the potential benefits they offer to crypto investors. Understanding cryptocurrency mining. Cryptocurrency mining is one of the oldest methods of earning passive income in the crypto world. It was popularized by Bitcoin, the first decentralized cryptocurrency, and remains a key part of many blockchain networks today. Mining involves using computer hardware to solve complex mathematical puzzles in order to validate transactions and add them to the blockchain. Miners who successfully solve these puzzles are rewarded with newly minted coins or tokens, as well as transaction fees from the network. The mining process. At its core, mining is a process that supports the security and decentralization of a blockchain network. Most cryptocurrencies, including Bitcoin and Ethereum, before its transition to proof of stake, use a consensus mechanism known as proof of work (POW). This mechanism requires miners to solve cryptographic puzzles by performing massive amounts of computational work, a process that consumes significant energy and computational resources. Once a miner successfully solves a puzzle, they broadcast the solution to the network, and the new block is added to the blockchain. In return for their efforts, miners are rewarded with a certain number of coins, which can either be held as an investment or sold for profit. The reward structure is designed to incentivize miners to continue securing the network and validating transactions. For example, Bitcoin miners receive a reward in the form of new Bitcoins every time they successfully mine a block. This reward decreases over time through events called halvings, which reduce the number of new Bitcoins generated and distributed to miners, making mining progressively more difficult. Types of mining. There are several different ways to mine cryptocurrencies, each with varying degrees of complexity, cost, and profitability. The main types of mining include ASIC mining, application-specific integrated circuit. This is the most efficient and specialized form of mining. ASIC miners are custom-built machines designed to solve specific cryptographic algorithms, such as the ones used in Bitcoin mining. These machines are extremely powerful but also quite expensive, making them suitable only for serious miners who are willing to invest significant capital. GPU mining, graphics processing unit. GPU mining is another popular method, especially for altcoins that are not mined using ASICs. GPUs are more versatile and can be used for a wide range of cryptocurrencies, such as Ethereum, Ravencoin, and others. While GPUs are less efficient than ASIC miners, they are more accessible to beginners and can be used for a broader range of coins. CPU mining, central processing unit. This method uses the processor in your computer to mine cryptocurrencies. CPU mining is not as effective or profitable as ASIC or GPU mining and is typically used by hobbyists who want to experiment with mining smaller coins. Cloud mining. Cloud mining allows users to rent mining power from a third-party service provider. This eliminates the need for costly hardware and high electricity bills, as the mining is done remotely. However, cloud mining has its drawbacks, such as the potential for scams and lower profitability due to service fees. Costs and considerations. While mining can be a lucrative source of passive income, it comes with a number of considerations. The most significant of these are the high upfront costs associated with mining hardware, the ongoing costs of electricity, and the potential environmental impact of large-scale mining operations. Mining also requires technical expertise and a solid understanding of blockchain networks, hardware maintenance, and software configurations. Furthermore, mining rewards can be highly variable, depending on factors such as the mining difficulty, the value of the cryptocurrency, and network competition. For miners who are just starting out, the initial investment can be substantial, and it may take a long time to break even, especially with the increasing difficulty of mining and decreasing block rewards. Understanding cryptocurrency staking. While mining involves using computational power to secure a network, staking offers an alternative approach that requires participants to lock up their coins in a wallet to help maintain the network's security and operations. Staking is a fundamental component of blockchains that operate on the proof of stake (POS) consensus mechanism, which was introduced as a more energy-efficient alternative to POW. Instead of miners solving computational puzzles, POS networks rely on validators who hold and stake coins to participate in the consensus process. The staking process in a POS-based network, participants, called validators, are chosen to propose and validate new blocks based on the number of coins they hold and are willing to lock up as collateral. The more coins a participant stakes, the higher their chances of being selected to validate a block and earn rewards. Staking rewards typically come in the form of new coins or tokens, as well as transaction fees paid by users of the network. To stake cryptocurrency, users generally need to lock their coins in a wallet that is connected to the blockchain network. The coins remain in the wallet but cannot be used for transactions while they are staked. The amount of cryptocurrency required to participate in staking varies from network to network, with some blockchains allowing users to stake smaller amounts, while others may require larger sums. Types of staking can be done in several different ways, each with its own advantages and risks. Solo staking. Solo staking involves setting up your own validator node on the blockchain. This method is typically only recommended for those who have technical knowledge and the necessary hardware to run a node. Solo stakers need to ensure their node is online and operational at all times to avoid penalties. Pool staking. Pool staking allows users to combine their funds with others in a staking pool, where they collectively stake coins and share in the rewards. This method is often preferred by those who don't have the required capital or technical expertise to solo stake. Pool staking allows for smaller minimum staking requirements and more consistent rewards. Delegated proof of stake, DPoS. DPoS is a variation of POS where coin holders delegate their staking power to trusted validators. In this system, users don't need to run their own nodes, and they can still participate in the staking process by voting for validators they trust. DPoS networks tend to be faster and more scalable than traditional POS systems. Centralized staking services. Some exchanges and wallet providers offer centralized staking services. In this case, users can delegate their coins to the exchange, which then manages the staking process for them. While this method is convenient, it carries the risk of relying on a third-party service, which could be vulnerable to hacks or mismanagement. Costs and considerations. Staking is generally considered to be more energy efficient than mining, as it doesn't require the intensive computational power associated with proof-of-work systems. However, staking comes with its own set of risks. The value of staked coins can fluctuate significantly, and there's always the risk of losing a portion of your stake if the network experiences a problem or if validators act maliciously. Additionally, some networks impose lock-up periods, during which you cannot withdraw your staked coins. While this ensures the stability of the network, it also limits your flexibility. Staking also requires a certain level of trust in the network's security and the validators you are supporting. If a validator behaves maliciously or fails to properly maintain their node, you may lose part of your staked coins as a penalty. Comparing staking and mining. Both staking and mining can offer passive income opportunities for cryptocurrency investors, but they have distinct differences that may influence which method is best suited to your needs. Energy efficiency. Staking is far more energy efficient than mining, which can have a significant environmental impact due to the enormous energy consumption required for proof-of-work mining. Staking allows participants to earn rewards without the need for power-hungry hardware. Technical knowledge. Mining requires substantial technical expertise to set up and maintain mining rigs, as well as to monitor the performance of the hardware. Staking, on the other hand, can be much simpler, especially when using staking pools or centralized services. Capital requirements. Mining can require significant upfront investment in specialized hardware, especially if you are mining more established cryptocurrencies like Bitcoin. Staking typically requires less capital, although the amount you can stake often determines the potential rewards you receive. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. The impact of market sentiment on cryptocurrency. The cryptocurrency market, often volatile and unpredictable, is deeply influenced by market sentiment. Market sentiment refers to the prevailing mood or attitude of investors and traders toward a particular asset, class of assets, or the overall market. In the context of cryptocurrency, market sentiment can be bullish, optimistic, bearish, pessimistic, or neutral, and these sentiments are shaped by a complex combination of factors. These include news developments, social media trends, macroeconomic events, technological advancements, regulatory changes, and even the opinions of key influencers within the industry. This video explores how market sentiment impacts the cryptocurrency market, highlighting the relationship between sentiment and price fluctuations, investor behavior, and the overall evolution of the digital asset ecosystem. Cryptocurrency is often considered to be a speculative market, with investors driven by emotions rather than fundamental analysis. This emotional investment is largely due to the market's high volatility. Unlike traditional financial markets, which are influenced by economic data, corporate earnings, or geopolitical events, cryptocurrency prices tend to fluctuate sharply in response to changes in investor sentiment. In fact, market sentiment can sometimes be the driving force behind price movements, rather than underlying market fundamentals. For example, a sudden surge in positive sentiment, driven by a favorable news report or a prominent individual's endorsement, can lead to a sharp increase in prices, whereas negative sentiment, fueled by concerns over regulation or security issues, can result in a rapid decline in value. One of the most significant ways in which market sentiment influences cryptocurrency is through price volatility. Cryptocurrencies such as Bitcoin, Ethereum, and smaller altcoins are notorious for their wild price swings, and these fluctuations are often triggered or exacerbated by shifts in sentiment. The impact of sentiment on price is often amplified due to the relatively small size of the cryptocurrency market compared to traditional financial markets. This means that even small changes in sentiment can lead to disproportionately large price movements. For instance, in December 2017, Bitcoin's price surged to nearly $20,000, largely driven by a wave of positive sentiment spurred on by mainstream media coverage, speculation, and the launch of Bitcoin futures contracts. However, in the months that followed, as market sentiment turned sour due to regulatory concerns and market manipulation fears, Bitcoin's price plummeted, losing over 80% of its value by the end of 2018. Social media plays a crucial role in shaping market sentiment within the cryptocurrency space. Platforms like Twitter, Reddit, and Telegram have become key battlegrounds for the spread of information and sentiment. Influential figures, such as well-known investors, entrepreneurs, and even celebrities, can have an outsized effect on market sentiment through their social media posts. A single tweet from Elon Musk, for example, can trigger dramatic price movements in cryptocurrencies like Bitcoin and Dogecoin. Musk's tweets regarding Dogecoin, in particular, have been associated with both sharp rises and falls in the coin's value. Similarly, Reddit's Wall Street Bets forum, which gained notoriety during the GameStop short squeeze in early 2021, has also become a place where cryptocurrency enthusiasts rally around certain tokens, influencing sentiment and price behavior. This social media-driven sentiment can result in both positive and negative feedback loops, where a surge in sentiment leads to further price increases, creating a self-reinforcing cycle, or where negative sentiment causes a cascade of selling, driving prices lower. The psychology of the market also plays a crucial role in shaping cryptocurrency sentiment. The herd mentality is a powerful force in financial markets, and cryptocurrencies are no exception. When investors see others buying into a particular asset, they often feel compelled to join the trend, even without fully understanding the asset's fundamentals. This behavior is particularly pronounced in the cryptocurrency market, where FOMO, fear of missing out, can lead to mass buying during bull runs. Conversely, when the market turns bearish, investors may panic and sell off their holdings, further driving prices down. This psychological aspect of the market is amplified by the inherent volatility of cryptocurrencies, creating a feedback loop that can result in extreme price swings. For example, during the 2017 Bitcoin bull run, many retail investors piled into the market driven by FOMO, only to exit during the subsequent crash, exacerbating the downward pressure on prices. The media also plays an essential role in shaping market sentiment. News outlets, both mainstream and niche, often report on developments that can have a significant impact on the cryptocurrency market. Positive news, such as institutional adoption of Bitcoin or the introduction of favorable regulations in key markets, can spark a bullish sentiment, while negative news, such as security breaches, regulatory crackdowns, or government bans, can trigger bearish sentiment. A particularly noteworthy example is the media's reaction to China's regulatory actions against cryptocurrency mining and trading, which led to a substantial drop in Bitcoin's price in 2021. As China moved to shut down mining operations and crack down on cryptocurrency trading, market sentiment turned sharply negative, and the price of Bitcoin fell from its all-time high of over $64,000 in April 2021 to below $30,000 by June of the same year. Regulation is another critical factor influencing market sentiment in the cryptocurrency space. Governments and regulatory bodies around the world are still grappling with how to approach cryptocurrencies. The lack of clear and consistent regulations creates uncertainty, which can significantly impact sentiment. For instance, when a country announces a crackdown on cryptocurrency trading, or when a government threatens to introduce restrictive regulations, it can cause panic selling and a sharp decline in market prices. Conversely, when a country adopts a more favorable stance, such as recognizing Bitcoin as legal tender, it can generate positive sentiment and contribute to a bullish market environment. El Salvador's decision to adopt Bitcoin as legal tender in 2021, for example, was seen as a major victory for the cryptocurrency space, leading to a surge in market sentiment and a brief increase in Bitcoin's price. Technological advancements within the cryptocurrency ecosystem also play a significant role in shaping market sentiment. Innovations such as the development of decentralized finance, DeFi, non-fungible tokens, NFTs, and Layer 2 solutions like the Lightning Network have attracted considerable attention from investors and have positively impacted sentiment toward cryptocurrencies. For example, the explosive growth of DeFi in 2020 and 2021 generated a surge in optimism about the future of blockchain-based financial systems, which contributed to a positive market sentiment and rising prices for many cryptocurrencies. On the other hand, technical issues, such as network congestion or security vulnerabilities, can have the opposite effect, leading to a decline in sentiment. The Ethereum network's congestion issues in 2021, for instance, led to frustrations among users and developers, which temporarily dampened market sentiment for Ethereum and its associated projects. Investor behavior is another important consideration when analyzing the impact of market sentiment on cryptocurrency. The relatively young and inexperienced nature of many cryptocurrency investors, combined with the allure of quick profits, often leads to a more volatile market. Many investors in the cryptocurrency space are attracted by the potential for high returns, but this can also lead to irrational decision-making driven by emotions. When sentiment is overwhelmingly bullish, investors may overlook the risks and enter the market without fully understanding the assets they are purchasing. Conversely, during periods of negative sentiment, investors may become overly risk-averse and abandon the market entirely, even if the long-term prospects of cryptocurrency remain strong. This short-term thinking can exacerbate market swings and contribute to the overall volatility of the space. Market sentiment is a crucial factor in determining the direction and behavior of the cryptocurrency market. The complex interplay of emotional drivers, social media influence, media coverage, regulatory developments, and technological advancements all contribute to shaping investor sentiment, which in turn influences prices and market dynamics. The volatility of the cryptocurrency market is amplified by the psychological factors at play, with herd behavior, FOMO, and panic selling often leading to sharp price fluctuations. As the cryptocurrency space continues to evolve and mature, understanding the role of market sentiment will be crucial for investors, traders, and regulators alike in navigating this dynamic and rapidly changing market. The future of cryptocurrency may depend not only on its technological innovations and adoption but also on the broader sentiment and confidence in the market as a whole. Long-term versus short-term cryptocurrency investment strategies. Cryptocurrency investments have attracted both seasoned investors and newcomers due to the high potential for returns, the innovation of blockchain technology, and the allure of decentralized finance. However, the market's notorious volatility raises an essential question: how should one approach cryptocurrency investing? Should investors favor short-term strategies that aim to capitalize on rapid price fluctuations, or long-term strategies that rely on holding assets for extended periods, betting on future growth? This video explores the two primary approaches to cryptocurrency investing, long-term and short-term strategies, discussing their advantages, risks, and the specific investor profiles they best suit. Short-term cryptocurrency investment strategies. Short-term cryptocurrency investment strategies are typically characterized by quick, active trades designed to capitalize on the frequent and often volatile price movements that occur in the cryptocurrency markets. These strategies aim for profits within a short period, which could range from hours to weeks. The most common short-term strategies include day trading, swing trading, and scalping. Each of these methods comes with its own risk-reward profile and requires specific skills and a deep understanding of the market. Day trading. Day trading involves buying and selling cryptocurrencies within the same trading day. The goal is to profit from the price swings that occur within short time frames, typically on an hourly or minute-by-minute basis. Day traders use technical analysis, charts, and indicators such as Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Bollinger Bands to make decisions. Since cryptocurrency markets operate 24/7, day trading presents opportunities around the clock. However, it requires constant attention to market conditions, a high tolerance for risk, and quick decision-making skills. For day traders, the ability to react swiftly to market changes and control emotions under pressure is key. Swing trading. Swing trading is another popular short-term strategy that aims to capture price moves over a few days or weeks. Swing traders typically look for a larger price swing or trend reversal within a shorter period. They use both technical analysis and fundamental analysis to identify entry and exit points. The primary advantage of swing trading is that it allows investors to catch more significant price movements without the intense pressure of day trading. However, it still carries significant risk, as market conditions can change rapidly, particularly in the volatile cryptocurrency space. Scalping. Scalping is one of the most fast-paced forms of short-term trading. It involves making numerous small trades to capture tiny price movements. Scalpers generally hold a position for mere minutes or seconds, looking for small profits that add up over time. This strategy demands a high level of focus and fast execution, as traders must navigate high levels of volatility and transaction fees. Scalping can be effective in highly liquid markets, where price fluctuations occur quickly and frequently. Short-term strategies are attractive to traders who enjoy active involvement in the markets and seek to profit from the near-constant price changes that characterize cryptocurrencies. The primary advantages of short-term strategies are the potential for rapid profits and the ability to take advantage of the market's volatility. However, these strategies come with significant risks. The high volatility in the cryptocurrency market can lead to substantial losses, particularly if a trade goes against the investor's position. Moreover, short-term traders often face higher transaction fees due to the frequency of their trades, and they must also consider taxes on frequent gains, which may reduce net returns. Additionally, this approach can be emotionally taxing, as the market's rapid pace and fluctuating prices demand constant attention. Long-term cryptocurrency investment strategies. Long-term cryptocurrency investment strategies, often referred to as hodling, a term derived from a misspelled version of hold, focus on buying and holding cryptocurrencies for extended periods, typically years, with the expectation that their value will rise substantially over time. These strategies are more passive compared to short-term approaches, as investors take a set-it-and-forget-it approach. Long-term investors believe in the potential of blockchain technology and cryptocurrencies to transform global finance, and they are willing to weather short-term volatility for the prospect of significant returns in the future. Buy and hold, HODL. The buy and hold strategy is the cornerstone of long-term cryptocurrency investment. Investors who use this approach purchase a cryptocurrency, often Bitcoin or Ethereum, and hold it for years with the expectation that its value will increase significantly over time. The belief behind this strategy is that, despite the short-term volatility, cryptocurrencies will grow in adoption, recognition, and value as the underlying technology matures. Bitcoin, for example, has seen remarkable growth since its inception, with periods of rapid price appreciation followed by steep corrections. Dollar cost averaging, DCA. Dollar cost averaging is another long-term strategy that involves investing a fixed amount of money into a cryptocurrency at regular intervals, regardless of its price. This strategy reduces the impact of volatility, as it spreads the risk over time and avoids the temptation to buy at market highs. DCA helps smooth out the entry point, and it works particularly well in markets that exhibit high levels of volatility, like cryptocurrencies. Staking and earning interest. In addition to holding, some long-term investors may choose to stake their cryptocurrency holdings or lend them out in exchange for interest. Staking involves locking up a certain amount of cryptocurrency in a blockchain network to support its operations, and in return, stakers are rewarded with additional tokens. Cryptocurrencies like Ethereum 2.0, Cardano, and Polkadot offer staking rewards, providing long-term investors with a way to earn passive income from their holdings. Similarly, lending platforms like BlockFi or Celsius Network allow investors to lend their cryptocurrency to others in exchange for interest payments. The primary appeal of long-term cryptocurrency investing is the potential for substantial returns. Many early Bitcoin investors, for example, have seen their investments increase by thousands of %. However, long-term strategies also come with their own risks and challenges. The most significant risk is the possibility of market stagnation or the failure of certain cryptocurrencies to gain mainstream adoption. While Bitcoin and Ethereum are widely regarded as the flagship cryptocurrencies with the strongest potential for long-term growth, other altcoins may face regulatory, technological, or competitive hurdles that prevent them from achieving widespread success. Additionally, the long-term nature of the strategy requires patience, as investors must weather significant price corrections and potential bear markets. Comparing long-term and short-term cryptocurrency investment strategies. When comparing long-term and short-term cryptocurrency investment strategies, it is important to consider the various factors that influence an investor's decision. One key difference between the two approaches is the time horizon. Short-term strategies focus on making profits within a few days, weeks, or even hours, while long-term strategies require holding investments for months or years. In contrast, long-term strategies benefit from compounding growth and a reduced need for frequent decision-making. The patient approach allows investors to take advantage of the cryptocurrency's long-term trends, potentially benefiting from price appreciation and technological advancements in the space. An important factor in choosing between short-term and long-term strategies is the investor's risk tolerance and personal goals. Short-term investors are typically more risk-tolerant and enjoy the excitement of fast-paced trading. They may have a higher appetite for risk and seek to generate quick profits. On the other hand, long-term investors are typically more conservative, seeking slow and steady growth over time with a focus on building wealth in the future. The role of technology and market trends in both short-term and long-term investment strategies. The ever-evolving nature of cryptocurrency technology and market trends plays a crucial role. Short-term traders often rely on the latest technical advancements, such as new trading platforms, automated bots, and advanced charting techniques to make real-time trading decisions. Long-term investors, on the other hand, may be more focused on the development of the underlying technology, blockchain adoption, regulatory changes, and macroeconomic factors that could influence the market's future growth. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.